Welcome to Market Peeker. Moving averages are powerful tools that help traders smooth out price data and spot trends more easily. Today, we'll explain the two most popular types: simple moving averages, SMA, and exponential moving averages, EMA. What is a moving average? It's a line on the chart that averages price data over a specific period, helping filter out market noise. Traders use it to identify trends and potential entry or exit points. Simple moving average, SMA. The SMA calculates the average price over a set time frame, like 10, 20, or 50 days. It's great for identifying general trends, but reacts slower to sudden price changes, which can make it less effective in volatile markets. Exponential moving average, EMA. The EMA gives more weight to recent prices, making it more responsive to market changes. This makes it a favorite for short-term traders who need quicker signals. How to use them in trading? Trend identification. If prices stay above the moving average, it indicates an uptrend. Below it, a downtrend. Crossovers. When a shorter moving average, like a 10-day EMA, crosses above a longer one, like a 50-day SMA, it signals a potential buy opportunity. A downward crossover might indicate a sell signal. Pro tip: use SMA for long-term analysis and EMA for short-term strategies. Combining both can give a clearer picture of the market.